has had a bearing on the attendance, because we have had about 70 registrations. But I think we've got a pretty lively debate to look forward to, and I can see there are certain gentlemen in the audience who I'm sure will probably ask some difficult questions.
It's always him.
There's always the odd troublemaker. My name is Nigel Silliter, and I'm going to be the moderator for this debate. Who can you trust to manage your wealth? It's an area I know pretty well. I've been in the region for some 22 years. I've met many wealth management firms, whether they be private banks or external asset managers. We've also mapped out every single firm. And also, if you follow me on LinkedIn, I'm very hot about unregulated firms. So later on, we will look at a topic which is how you can spot an investment scam, because with growth in an area like the UAE, it does tend to attract scammers as well. So I'm a firm believer in regulated advice, but unfortunately, unregulated firms are on the rise. And if you are an investor looking to give your money to someone who you can trust, then just be very wary about using a firm that is not regulated locally. They might be regulated somewhere else, but they are operating illegally if they're based here and they're not regulated by one of the 4 regulatory businesses, which are the DFSA here in the DIFC, Abu Dhabi Global Markets, ESCA, and the UAE Central Bank. So it's always very important to ask any firm you deal with who you actually regulated by locally. Just a couple of housekeeping rules. We appreciate it if you keep your phone on silent, and there will be plenty of opportunities at the end of this debate in, let's say, 40 minutes or so, to ask whatever question you like. It is, however, Chatham House rules, so everything that is asked or questioned within this room will have to stay in this room. And please say there are no journalists present today, so we can all talk pretty freely. And what we're going to do over the next 40 minutes or so is explore the wealth management sector, look at some of the latest trends, and determine where you can go for trusted, sound, impartial wealth management advice. And as I said, we will also look at some tips for avoiding investment scams. And I'm pleased to say we've put together a very distinguished panel today. So I'll start off with DJ, as I'll call you from now on. I've known DJ for many years. DJ Sengupta. He is the CEO of Rise Middle East, which is headquartered in Singapore. You've had an office here in DIFC for how long?
About 18 months now.
18 months, great. And he's got about 25 years experience working in the financial services industry across the MENA region. He's held various senior positions within international financial institutions like Citibank NA. And as I said, he's now a CEO of, can I describe it, an external asset manager?
Yes, that's what we call it.
Okay, yeah. An EAM. And for those of you who aren't too familiar with EAMs, we will obviously describe them later on. And for the interesting bit, because who cares really about bios and where you've worked, outside work, DJ is an advanced open water diver.
That's right.
Which is very interesting.
It doesn't look like one, but here I am.
I thought that was an applause moment. But...
And to DJ's left is Daniel. I'll call you Danny if that's okay. Yeah. So Danny George, he's head of business Middle East for St. James Place, which is a quoted FTSE company in the UK. Danny's previously worked at the Nationwide Building Society and NatWest, and is a financial services leader with a demonstrated history of working in the industry. The most interesting thing, though, outside work, is that he used to be a former professional footballer, started his career with Nottingham Forest under the legend of Brian Clough. I think you worked for 3 professional football teams. And he stays active by coaching young players to hopefully achieve their dreams. And he's also a fully qualified U4B football coach, which I think means that you can manage any team up to championship level in the UK.
Yeah, absolutely.
Excellent.
Maybe say if it doesn't go quite well here, I've got another another opportunity knocking at the door.
And to the left of Danny is Cornelius, so I'll call you Con if that's okay.
Please do.
Con Lillis, who's chief executive of Abacus Financial Consultants, a firm I know very well. He's lived in the Middle East for Dubai for some 32 years. But what's interesting is he started his career as a police constable in the UK. with the Met from 1982 and 87 and was part of the Riot Squad
For a while, yeah.
for a while. So I'm sure you got some interesting stories there. He then transitioned to the financial advice sector. And like our next panelist, he's a very keen golfer. And you've got a license to fly planes, is that correct?
Yeah, PPL in the UK. It's just
What's that mean? Small planes, like two
It's a
seats?
single-engined aircraft. I can handle one of those.
Okay,
Have a
fine.
license
But
for
not
that.
an Emirates.
Not a big
Okay.
plane, no, nothing too commercial.
And to Con's left is Damien Hitchin, who also know very well. He's CEO of Saxo MENA, and he leads Saxo Bank's expansion strategy in the MENA region. And he's worked for 2 leading digital banks in the UAE over the last 10 years. I think you had a stint in Singapore, didn't you? Setting up,
Did in the middle, yeah.
yeah, in the middle. And you've been back here for how long?
We're back here for 2.5 years now, post.
Great. And these businesses all regulated by the DFSA, with the exception of Con's business, which is regulated by ESCA. I'm sure you have many other regulatory.
We're UAE Central Bank.
Oh, UAE Central Bank. My apologies. So we have UAE Central Bank, ESCA, DFSA, and DFSA. And outside work, Damien's avid golfer and coaches junior rugby in Dubai for the Hurricanes Club. So that's it on who the panelists are. What I thought we could do next before we ask some questions is just look at who the players are in this region. So our company Inside Discovery actually mapped out all the regulated firms a while back. And what might surprise you is that there are 62 private banks in the Gulf region. 31 of those private banks are international firms, and every single one of those 31 international banks has an office here in the DIFC, which is quite staggering. So basically, this is the hub for international private banks wanting to do business in the Gulf. So besides the private banks, you have 75 external asset managers. They're all here in the UAE. And EAMs is probably a new term for some of you. So maybe DJ, you could explain what an external asset manager does.
Sure. Thank you, gentlemen, for joining us this evening. Some of you know how the private banking world works. Many of you, I'm sure, are clients of private banks. The way we describe an EAM is when you have your assets custodized in a private bank, you're working with one private bank. And when you're working with one private bank, there are certain limitations that proprietary products have within the bank. I mean, you can, depending on your wealth, you can have a second bank or a third bank, but most of us have a relationship with one bank. When you work with an EAM like us, it's like working with the entire hand. So we sit in the center and we help you open your accounts and manage your accounts across multiple private banks. I guess it's a closed forum, it's okay to take names. Many of you do products like structured notes. UBS, given the, I'm getting a little technical here, but UBS, given the kind of Chinese stocks they hold, they can price a structure with Chinese stocks better than anybody else in the world. But if you are banking with the Bank of Singapore, you don't get the benefit of that. So when you work with the EM, we independently manage your assets, but we custodize the asset across multiple banks. That's what an EAM does.
Yeah. And just for clarification, there are lots of EAMs here in the Middle East, and they're often set up by ex-private bankers who get disillusioned with the bureaucracy of the private bank. So they take an anchor client with, let's say, $50 million, and then they set up here in a regulated entity like the DFSA. So it's a big growth area. EAMs.
Yes, it is a growth area, but we are a little different. To give you a 1-minute pitch from my side, we are licensed across Singapore, which is MAS, Hong Kong, and DFSA, the regulator of the IFC, and we're just about to receive our license for Japan as well. So we are not a small setup. We are about little over 2 years old, and we've already built $2.5 billion of assets.
Great, thank you. And just to clarify, there are also 75 wealth management companies in the UAE, regulated either by the DFSA, ADGM, or ESCA. And we have found there are about 40 such firms outside the UAE, but within the GCC. Then there are 65 insurance brokers, which are relevant to this discussion, because insurance brokers tend to market car insurance, well, good luck with that, and house contents insurance, for example. And this is what's really surprising. There are 25 online trading platforms, rather like Saxo Bank, operating here within the UAE. So when I came to Dubai maybe some 17 years ago, there were very few players, very few regulated entities. It was a bit of a Wild West as well, but things have certainly changed for the better, hence the slide showing the numbers. So before I get on to some really quite sensitive and controversial topics, let's ask each panelist to quickly introduce their business. Most importantly, the type of client they're dealing with. So if you could quickly answer the following 3 questions. 1, who you're regulated by. Let's clarify that again. Which type of clients you're dealing with, and what's your minimum investment, or put another way, what's the minimum investable assets a client needs to have in order to set up an account? So DJ, you first.
Right. I mentioned a little bit about EAMs. We are licensed by DFSA locally, but we are also licensed by MAS and the Hong Kong regulator. $2.5 billion of assets under management that we have. We are a pure play private banking business. So we onboard a client only when he starts a relationship with about $3 million of assets. So, we are not in the retail play. We are in the higher end of the play because the banks we work with, they will not onboard a client below that kind of assets.
Yeah, but not everyone has to have 3 million, I'm pleased to say, to get advice. So maybe now we'll move on to St. James's Place. And Danny, if you can just answer those 3 questions quickly.
Yeah, sure. So thank you all for coming today. Said head of business for St. James's Place. Was formed in 1991 and entered the London Stock Exchange in 1997. We've recently opened an office within the last 12 months in the DIFC, and we're regulated by the DFSA. In terms of the clientele that we reach out to, we kind of we open up for all clients, so to speak. That's whether retail clients or that's high net worth. And we can start with such as little as £500 regular savings per month to get people on their savings journey. So having that open view of obviously of the retail angle.
Thank you very much. And Con, if you could describe your business and the sort of clients you also focus on.
Yeah, we're an independent advisory firm. We're financial planners. We deal with individuals and corporations that have at least 250,000 investable.
Is that dollars?
US dollars.
Yep.
Yeah, that's our level. We go up to not too high. I think our larger clients are around 5 million US. So that's our level. We're regulated by ESCA, which is the Securities and Commodities Authority. And what was the other question?
That's it. Oh, the minimum you described. So that's
Yeah,
fine.
minimum.
That's all. And then at the other end, these are all advice-led businesses. Some people might prefer DIY or a mixture of DIY and advice. So maybe, Damien, you can introduce Saxo.
Thanks, Nigel. Good evening to everybody. Saxo Bank Group. So locally here, we're regulated by the UAE Central Bank. We have offices in 14 countries globally. We've got over 1 million customers. We've got over $100 billion in assets. Our business is split between our direct clients, which are private individuals, which encompass about 2/3 of our business. Those can range from people who've got $5,000 with us, an open account. We have certain individuals who have more than $100 million with us, but we do operate on an execution self-directed basis. So clients are using our global market access. The other third of our business is what we call institutional partners. So whether we are people like DJ with the EAMs or other tier 1 banks. So I'm not giving anything out of school here. So for example, HSBC in Singapore use our trading infrastructure. Probably 75% of the banks in the region here use our trading infrastructure in some way or form. And they typically will use our trading infrastructure for their end clients. So they'll offer their white labeled brand of our trading platform, but they'll custody and settle through Saxo. So it's a fairly diverse business.
Great, thanks. So the whole topic is trust, because every sector, whether it be F&B or oil and gas, financial services, you always have some reputational risks. And if you think about Madoff, which didn't happen too far back, the wealth management industry occasionally has good times and bad times. So what I thought would be useful is to start off by looking at the changes that have been seen in the wealth management sector over the, let's say, last 5 or 10 years back, because a long time ago, it's a bit of like the Wild West, but regulation has tightened up here. It still has a long way to go. So maybe I'll just ask 2 of you to look at what's changed and how it's protected investors over the last 5 or 10 years. So I'll start with you, Damien, if you don't mind.
Sure, I think it's changed significantly, and I think I would observe that when I came to Dubai in '99, it was very much the Wild West, and it probably still was the case in 2010. I would argue now that it's probably a top 10 global financial centre, and the regulations and the governance here has improved dramatically over the past decade. On a private client basis, I think we're all now subject to global best practices in terms of client onboarding, in terms of knowing your client, in terms of ongoing due diligence and client renewals. I don't think we're any different from what I saw in Singapore when I was there for 2.5 years, or under the FCA in the UK. So I think that's moved on significantly. And if you're a private investor, you should take great comfort in that, for the most part, we are extremely well regulated now. The other aspect I would say is that if I look at our partner business, if I looked at my previous firm 7-8 years ago, we were fairly flexible in terms of who we took on as partners. But now when we're taking partners on, we go through a full due diligence process in terms of their business, in terms of how they operate their onboarding procedures, how they do their renewal procedures, etc. So I think it's changed significantly. One aspect that has helped on the private side certainly is the digitization of our industry and the ability to do things digitally on platforms, at least to a certain extent. And I think that's improved the governance and the regulation significantly.
Great. And DJ, given your experience?
Yep. So, I wouldn't delve into what Damien already covered. But one significant change for every client is the cost of transaction has come down significantly. And that's also thanks to firms like Damien's. There's a point of time when financial services to be provided was an expensive proposition. It's not so. In terms of regulation, Dubai, DFSA, central bank, they've come a very long way. There was a time 10, 12 years back when clients and advisors actually thought Dubai was a great place to operate because they called it the regulatory arbitrage. If you think of the word regulatory arbitrage, it's almost going against client ethics, right? Why would you want to have that arbitrage? Very, very happy to say that the regulators have closed that gap significantly. I was in a meeting, surprisingly a 2.5-hour meeting with DFSA about a month back. One part of the regulation which hasn't caught up, but they're very clear it's on its way, which is a regulation towards individual advisors. If you see any action that has been taken in the past, and I know Phil is nodding, we always struggled with this. Most of us struggled with this, that the firm would be penalized, but rogue action by individuals would not get penalized. That guy would go and work somewhere else and repeat the same things. But DFSA has clearly told me that that's on its way in the next 3 months. And that's great news for all of you as clients.
Good. Okay. Before we come on to scammers and what to look out for and transparency, which is key to build trust, maybe I can ask each of you, what does it take to make a good wealth management firm to build trust with clients? So as DJ, you've just spoken, maybe I can start with you.
Yeah, absolutely. So for me, it stems around what are classed as the 3 R's, which is first of all, reputation. It's then results and relationship. Reputation is absolutely crucial. It's about being, like, as you just said there, Nigel, about transparent. It's about dealing with your clients ethically and morally and doing it in the right way. Client satisfaction will always feature into reputation, but that is so important when you look to build trust. Touch on results, and I'm not always talking about returns when we're talking about results. It's about creating a unique and exceptional client experience, and it's being with that client along the full financial journey. It's seeing them when they need you the most, but also supporting them to achieve their hopes and dreams about what they're looking to do in the future. And then that falls into relationship. By creating that relationship, getting to know and understand that particular individual, their family, their close connections, professional connections, is vitally important to build that trust and have that connection through to the end point. And with that, you'll have, clients that stay with you, they'll recommend you, they'll repurchase from you, and they'll retain as a client of your particular business. And I think that is absolutely vitally important, and it falls into that customer satisfaction.
Great, thanks. Con?
Yeah, I think going back to the original question about how the industry's changed, I think it can either change externally by influence from, let's say, regulators, or it can change internally. I think we set out to change ourselves internally quite a long time back. And we thought it was a very important thing to be totally transparent with our clients. And I found that this place hasn't been transparent in the past, whereas I think now it's moving towards that rapidly. We've been transparent with our clients completely with regards to fees and so on for at least 7 years in this market. I think we're slightly ahead of the game. I think everyone is now catching up with that. And I think the regulator is reinforcing that by bringing in rules and regs that will actually force that upon the industry. We already have a situation under the ESCA regulator that only fully qualified advisors can give advice.
What's the qualifications for then your advisors within
It's not
ESCA?
external necessarily, but you have
Right.
to do internal qualifications
Okay.
to become a financial analyst. At the end of the day, the financial analyst within the firm has to oversee every single bit of business that goes through the firm. That protects, to an extent, the advice that's being given, because any advice that's being given by any advisor within a firm has to go through the financial analyst, who is accountable to the regulator, before it can actually hit the market and actually go to market. I think that's a very strong requirement. I think it's a good requirement. And I think it's certainly something we've welcomed over the last few years.
Okay. Well, in actual fact, sorry, I'm going to now ignore DJ and Damien for 1 minute, and we're going to ask a very important question about transparency. So let's imagine somebody from this room signs up as a client. They meet all your minimums. You do a very detailed KYC. When they receive a report, because you've invested X into a structured note or a mutual fund or whatever it might be, how much transparency is shown in terms of the fees and the commissions that are paid from the products or the services you're recommending? So it's now about transparency, because 10 years ago, this industry wasn't very transparent over here. The UK definitely is very transparent because of all the legislation. So maybe I'll start off with you, Damien, if you don't mind. So someone's just opened an account and they're doing some trades, whether it be crypto or ETFs or whatever. How much transparency is there?
For ourselves and within online trading platforms, it's a foundation. I mean, you cannot be an online trading platform without having complete disclosure of your fees and charges on your website, because online traders, because they're self-directed, will walk around different websites and have a look at different propositions. And price is, I wouldn't say it's the only choice, because you have to marry that with investment access and global market access and product access and platform usability. But if you're in the online platform trading game, you cannot be anything but 100% transparent.
Okay, so these 25 online brokerage firms I mentioned earlier,
Yep.
Are they all offering the same transparency?
They can be creative, but if you're depends what level of sophistication you are. So if you're buying stocks, for example, it's pretty straightforward in terms of whether it's a basis point fee or a flat fee, etc. If you're using leverage products, and you're new to leverage products, then you need to be careful, because some fees can be wrapped up. It might be a commission, it might be an overnight lending fee, it might be a swap fee, etc. People, as they move up their sophistication levels and become traders, will quite quickly get up to speed with how the market plays out. The other thing about the online trading marketplace is there are a lot of independent marketplace sites that are comparison sites. So it's quite easy to go in within our industry, our sector. It's quite easy to go onto comparison sites and get some independent, and I would argue pretty balanced reviews of how the different platforms.
Their charging structures.
Yeah.
Okay, great. And what about you, Con? Because I know sometimes you're recommending, let's say, discretionary portfolio management services where you're outsourcing the fund selection. So again, what about the transparency when someone takes out a
100%
contract?
transparency has to be displayed. We do a full analysis for the client before we enter into any business or recommendations. We present a full report. That report has to present a full table of costs that are going to be involved with any of the products.
And does the client have to sign this?
Has to sign it,
Okay.
has to see it, has to be signed off by the analyst. There's a whole series of things now. I think what we're witnessing now is a situation where you can be rest assured that if you're going to be investing in this marketplace, as long as you follow some common sense and a couple of pillars perhaps of things that you should be doing as basics to actually make sure that there is trust in the industry or in the firm that you're dealing with, it's much safer now than it was, because there are so many other people involved. It's much more competitive. It's much more
And
transparent.
then later on, we're going to ask about recourse. If there is, let's say, a complaint, what's the procedure? But we'll come on to that later.
Yeah.
So, Danny, what about the transparency within St. James Place? What's the onboarding process, for example?
Exactly that. You complete your enhanced due diligence, and obviously the advisor will sit down with the client as part of one of those meetings. They go in depth about charges, what exactly that the client will pay, and be very transparent and clear about those charges. And very much the same as what Con was saying, they need to go through that with the advisor, sign to say they fully understand the fees and charges that they will pay for the said investment. And they then will receive what we class as a suitability letter received to the client about everything that they've done from the point of contact, where they've said, that whole client journey from start to end. That report will detail all those fees and charges that are in there.
Got it. I know you're not a private bank, but private banks sometimes get it in the neck for not being always fully transparent. So what's your take on what do you do at your firm, and then what do private banks typically do when it comes to transparency?
So, a funny thing, private banks are actually very transparent. Private banks disclose the charges that they take, but the private banking relationship still continues to be a lot about wining and dining the client. So when you trust your relationship manager, you go out for a drink in the evening, you decide on a product, and you put your signature. There's only one person you can blame, right?
Okay.
So we always say this: trust can only be broken by a guy that you trust in the first place. So private banks and us, we disclose, but a lot of times clients get taken in by the whole glamour of the private banker, taking him to Roberto's, opening a glass and opening a bottle of expensive whiskey. We tend to like that and trust those guys without thinking that's exactly the guy we shouldn't trust. But what we do is we don't leave the trust factor and transparency to one person. So no deal will go through if you meet a relationship manager and sign up. There has to be a second level sign off on every deal.
Okay.
Only then it goes through. So that's how we kind of manage that.
Got it. And one thing that can damage the reputation of wealth management is deep fakes and AI and Instagram posts, for example, luring people into what looks like very attractive returns, guaranteeing 4% a month. So, what is the situation regarding deep fakes and the impact that might have on the wealth management industry? I know it's a pretty hot topic for you, DJ. So
Yes.
maybe you can start, and then anyone else who wants to jump in.
See, AI is revolutionizing the world at a faster pace than when internet first evolved, right? Whatever tool comes in, it's how we navigate with those tools. And we always have to remember, unfortunately, some of the very early adopters of these tools are smart people, but they decide to use their smartness in negative ways. And we have to be a step ahead. Right? People get conned, people get scammed. AI, the moment we start believing that I can put in a question into ChatGPT and what ChatGPT throws out is the right answer, we need to ask ourselves who fed in that data into ChatGPT in the first place. I can make my ChatGPT work in a way that I want it to work. I can ask it to write a simple thing, a simple, 10-line comprehension or whatever you want to call it. ChatGPT, because it's fed American English, it'll say sidewalk. But I can immediately write in ChatGPT and say, don't write sidewalk, say pavement. It'll change that. So we have to be a step ahead. There are people who will use technology. This has happened for hundreds of years, right? People have used tech both for positive and negative impact.
Okay.
The only way to protect ourselves is be aware of that and know how to use it for our own good.
Yeah, and also maybe to ignore influence or finfluencers, as they're now called, like the Kim Kardashians of this world, who might be launching private equity businesses, for example. But that's for another day, I think. So, Damien, I'm sure, you've got something to say.
Just one other point on technology, and obviously we've all gained huge benefits from technology, but when it comes to AI, we recently, our global head of IT security recently gave a bank-wide presentation, and what he'd done is used our AI tools to imitate our chief investment officer. And he literally imitated them to an extent that I could probably not tell the difference between whether it was Steen Jacobsen or the AI version of Steen Jacobsen. So we need to be very careful about how these tools are used going forward, because there's always dangerous actors out there. So from that perspective, whereas it's pretty normal now to use two-factor authentication, so you're logging in either using fingerprints or an OTP, or etc., we're now on three-factor authentication. If clients choose to use that, they can choose not to use it. And we also now ask clients to list their trusted devices, and we have a limit on how many trusted devices they have. Again, it's slightly different because we're an online trading platform. And we also use IP geolocation tools now extensively. Now, we do that for a number of reasons. We use it for sanction protection, because, for example, if you're on a business trip into Iran, for example, you can't trade US markets with us, because that's our IP geolocation tools that prevent that. So they can be used in a very beneficial way, but they can also be used in a dark way. So I think everyone needs to be aware of that. And the industry needs to keep on top of that, as DJ says, because there's always some people out there looking to take advantage.
Got it. And Danny, Con, do you want to add anything?
Yeah, I think is what's been highlighted already here. What you've got is several very well-established companies here, which are going to give great protection, but they're not necessarily, I think, going to assist with the common man when it comes to the common man coming to market and trying to decide what to do. It's quite complicated. So this is where a good financial advisor comes in, because they will know about all of the products that are available in theory, or a lot of them, and they'll be able to identify where the best places to invest are generally, such as the legislation that's in place in certain countries, for instance. So they'll be able to give advice on that. So it's either a case of you do a DIY job where you scroll through the internet and you might come across a dodgy website and invest in it by mistake. That's one of those things. And if you are just going to look at these fabulous websites that replicate other fabulous companies, but they're not the genuine thing, that's the danger. The danger is in DIY investing. And this is why I think it's really important to establish where you are in the investment ladder, if you like, whether you're at the top, whether you know your clients, you know the game, you know the market, you've done it all before, you're a sophisticated investor, you know what you're doing, and you can contact the people that are already trusted within the industry for you. If you're not in that top end of the ladder, if you're at a different level, that's where I'd say financial advisors come into their own, because they can help with getting you started, pointing you in the right direction. They're very keen to help you with getting going on this stuff, to make sure that you become a client long term. So we've already had, let's say, 30 or 40 years, collectively hundreds of years of experience that we discuss in the office. We make sure we're actually going in the right direction. We're recommending the right products and companies. So we can shortcut all of that DIY type risk that you're taking yourself. And I think that's where this panel, I suppose, is so diverse that it's a little bit confusing to hear from, the 100 billion, was it, under management, whereas we're way at the other end of the scale. We've just got ordinary clients that have got a few 100,000 that want to invest in a secure and safe place for the future. We can then present what's possible. We can take into account their attitude to risk, as can other advisors, and then we can guide them towards things that are fully appropriate and fully tried and tested. It's not just finding a web page that you're going to take a punt at. It's something that we know works. It's worked for years and years and years. And depending on what it is you're trying to do, we can help with that process, if you like. It's at the lower end of the pecking order, if you like, to a private bank, where a private bank would accept those high net worth clients who've got a much better idea, let's say, about what it is they're doing. So they're in, it's all secure. They buy something specific from that particular private bank. It does a job. They know what they're doing. It's very different to us. We don't take on board any client money, and most of independent financial advisors don't. They simply sit on the same side of the table with the client, and we go looking for the thing that's right for the client, and we go looking together. You're buying into the expertise of somebody who's been independent for years, who has looked at and studied and experienced financial planning for years and years and years, and that's where our strength comes. There'll be other strengths on the panel, different to that. So you've got to sort of understand, I suppose, where are you at? That's the question. Where are you at with your investing? And then try and decide. And if you're not 100% confident with what you're doing, speak to a good financial advisor.
Yeah.
Independent, qualified,
I agree.
legal.
And also one of the advantages of advice-led businesses, hopefully there's diversification. And we did a debate a while back looking at crypto, gold and real estate. It was a incredibly hostile debate and everyone was arguing amongst themselves. I remember it well. I was the moderator. I was very tired at the end. And the guy who was talking about crypto was adamant you should put 100% of your money in crypto. Is going to increase tenfold over the next 5 years, for example. So diversification is key. And this is leading on to crypto because the UAE wants to make this market, one of the main hubs for crypto. And Binance, for example, this crypto platform have hundreds of employees down the road in Abu Dhabi. So it'd be useful to get some people's perspective of crypto because it is forming part of maybe a small part of some people's portfolios, but about a third of all the UAE residents apparently have exposure to crypto in one form or another. I wish I'd invested, I must admit, many years back, but I don't understand the subject. So I know, Damien, you have probably some crypto traders and you are open to crypto. So maybe you can just touch on this.
Yeah. So my last two firms have been very pro providing access to crypto assets. I think for me, on the crypto side, there's probably more risk on the regulatory side and the governance side because it's brand new. It's very nascent, and that's not just here, that's globally. I mean, we've recently only just seen our first crypto ETF approved in the US 2 months ago. So I think you need to be very careful, particularly here, because whilst the UAE has a large appetite to be a crypto and blockchain center, it's very, very new. It's very nascent, and governance around that can be challenging. I'll just give you a personal example. I mean, I've been dipping into crypto for about a decade since it started. And recently, one of the challenges of cryptos, and it comes back to what DJ was saying earlier about having different custodians or different wallets, is it's actually quite difficult to hold all your different crypto tokens in one wallet. And I recently had some tokens I bought years ago, and you get contacted by the wallet or the provider or the exchange who are closing down. And then you have to transfer your cryptos from that particular one into another one that you have. And I use Swissquote, I use Coinbase, etc. And that's actually very, very complex. So there's multiple risks with crypto outside of the volatility, because volatility is built in because it's a nascent asset class. Personally, I think it should be a proportional allocation of your portfolio, but be careful. And it's not just about the allocation portfolio size. It's also about the portability and how easy it is to liquidate it and how easy it is to move it from one place to another place, because it's very, very early stage.
Got it. Thank you.
See, I mean, on the crypto space, and this is something we hear all the time. Questions are asked around that. What's crypto today was something else 10 years back. There is always the novelty factor coming in, and it is given that none of us here would understand everything about that asset class. When you want to get in, that doesn't mean we neglect a new asset class. When we get into a new asset class, go slow, invest a little, learn everything about it, and as you feel comfortable, keep increasing your investments. Don't go all in just because Nigel has made 120% return in crypto, so I should get in. By the way, that's true about equities as well. That's true about any other financial product as well. Don't do it because the guy next to you has done it. When you get into it, get in it little bits and bots, and then kind of increase as you become comfortable.
Got it. Thank you. Before we open up to questions, I thought it'd be useful just to look at the rise of investment scams. It's happening all around the world. I'm sure you've had cold calls as well. I had a very funny call from a firm. I'm trying to remember their name. They're not regulated here. I don't think they're regulated anywhere. They operate in Emaar Square or somewhere, and they promise 4% a month, and you get back 90% of your original capital after 1 year. And when you go to their website, they make all these promises. But what's interesting is they don't list any of the executive team. And they did invite me to their office, which I might take up, and I'll probably take someone from the police. But it's useful just looking at how to spot an investment scammer. And you obviously sometimes have high pressure sales tactics, exorbitant returns. There's one company here that keeps advertising on planes and elsewhere, saying 18% a year. You probably know which firm I'm talking about. They have a very nice office in the Burj Khalifa. I'd always be very wary about any company, hopefully they're not here today, who actually makes these promises. No risk or guaranteed returns. They're evasive with their answers. Claims that the investment doesn't have to be locally registered. Unprofessional business-like conduct, or a website that looks a bit odd. It's particularly when they don't, as I said, list the management team. And they could say they're regulated somewhere, but it might be in a country that has very light touch regulation. But the firm that gives advice here must be regulated. And that's one of the first things you should always ask, who are you regulated by? And then check the website of the regulator to make sure that is actually the case. And when they post on LinkedIn or Facebook, if they actually don't allow comments to be added, that's another red flag, in my opinion, because they don't want someone like us saying, well, who are you regulated by? Or how can you guarantee 18% a year? And the other thing I'd be a bit wary about is investment awards. Not all these companies are dodgy. In actual fact, Investcorp is a very respected organization in Bahrain that specializes in private equity, for example. But there's one company here that surprised me as being shortlisted because they're not even regulated by anybody in the world. But the publisher has allowed them to be nominated, probably because they're advertising in this magazine. So the media sometimes are to blame because they will take a quote from someone who's not regulated. They don't do enough due diligence to ensure that the executive being quoted is working for a regulated firm. So some of these companies are good, but there's one, and I won't mention them, who I'm amazed they are even being nominated. The companies that are missing here are the Invescos, the Schroders, the BlackRocks of these world. You know, they are global asset management companies that probably do deserve an award for being the best asset management company operating with a branch in the Middle East, not one or two of these firms. So again, if you see an advert that is claiming that they are award-winning here and there, remember, these awards can often be bought for a fee for advertising. So I think what we should do, because I always prefer it if it's more of a Q&A session, why don't we open it up? And if you're watching on LinkedIn and you have a question, then send it to either the Capital Club or me at info@insight-discovery.com, and I'll check to see if any questions come through. So who would like to start things off by asking whatever you want? Remember, this is Chatham House rules to any of the panelists here. Who would like to go first? Yes, sir. And I need your name and company, please.
Hi, yes. My name is Naresh. I work for JP Morgan. DJ, a question for you. Could you please just spare 2 minutes to explain what is the revenue model for an external asset manager?
Right. So there are different revenue models that EAMs follow, right? Some of them will work on a custody fee, an all-in fee. It can vary anywhere from 20 bips to about 100 bips. That's 0.2 to 1%. There is sometimes the revenue that you make on the product, and then the private bank and the EAM shares that. So there are both kinds of models.
Great. Nice question. Any others? Don't be shy. We have a mic as well. Yes, the gentleman, if you can take the mic, actually. And your name and company, please.
Good evening. Hello.
Or just shout loudly.
Hi.
Good evening, gentlemen. Thank you for the discussion. Not working.
Shout.
Yeah, good evening, gentlemen. Thank you for the very enlightening discussion. My name is Ritesh, and my company name is Capmore Financial Services. I would like to know, is there any possibility of guaranteeing an 18% annualized return? I've come across these ads.
Yeah.
I don't understand them. You guys are specialists, so please enlighten me.
The short answer is no, I think.
Yeah, I'd suggest it's very, very doubtful. You might see an 18% yield coupon on a structured note, but structured notes then will have knockouts.
Yeah.
So if it goes south, then beyond that, you'll lose a portion of your capital, if not all of your capital. So I would say it'd be very, very unusual to take any comfort in somebody who's advertising an 18% guarantee return.
Agreed.
John, do you understand? Yeah, you understand that. Basically, the interest rate can be guaranteed, but the capital might not.
Yeah.
You may lose your money, but that will be written somewhere in the contract. It may not be apparent, from the advertising campaign, but in there somewhere it'll probably say, your capital's at risk if things go bad behind the scenes. That's what you've got to be
And
careful.
if the front person, the ambassador, is a famous ex-footballer, that's another red flag.
Yeah.
I'm sorry.
But not Danny.
We said famous.
Dan-
We said famous.
Dan-
Yeah.
Yeah, but Danny's not part of the.
Yeah.
He's not.
And
He's
he's
not.
not
He's not an
famous,
ambassador
yeah,
for.
yeah.
You're not appearing on adverts for St James Place.
But I do think it's quite interesting because we've talked about, I'm not going to use the word scams, but those headline things are attention grabbing. And, if you don't do the due diligence and don't do the research behind it, you could get pulled into sort of things like that. So I think, from all the things, we've talked about on the panel today, is to be aware and to make sure that you understand what you're buying into and what you're creating there. But they are very clever, some of these headline rates.
Yeah, Philip.
Philip Story, Investors Trust, for 20 years, and also the DIFC Insurance Association chairman. What one thing would each of you do to improve the regulatory environment here and improve the wealth management?
Good question.
You mean DIFC?
No, well,
ESCO,
what would you advise your regulator? What one thing that could they do better to improve?
I think it's probably universal education of the advisory, because it's all very well having a requirement to have a financial analyst signing off all the business. You've still got to know what's being said down the line, really. I mean, the important thing is what's going into place, and that can be checked by the analyst. That's fine. It's a good step. But in terms of the company's reputation, what's being said further down the line poses a risk to companies, if you like. And as a company, it would be nice to know that the advisors that are out there on the street are giving pretty much a uniform, tried and tested line with regard to how you go about building a portfolio or just building capital for the future. And amongst other things, taxation, mitigation, and so on. But that's very much an advisory thing. It may be slightly different with private banks.
Yeah.
I mean, I'd like to go. I would like to go last because Phil, you know me. I have some very strong opinion about these things. Let's hear the rest, and then I'll.
Yeah,
tell you what I think.
following on, I think for me, consistent transparency is absolutely the standards that we should all, come together and meet. And that would be my advice, that we all declare and be very clear about everything in terms of portfolios, products, charges, and making sure that there is no opportunity for anybody to not declare everything about what the client or that consumer or that retail individual is getting into and fully understands. And that's where we need to get to.
To no making money by sleight of hand.
No.
That's good. Yeah.
In addition to those 2 points, I'd probably say enforcement and recourse.
There's a good one.
Later.
Yeah.
It's got much better in the last decade, much better. But I would say historically here that regulators have been very good at writing rules, getting better at supervising rules, but executing and collecting on issues, I would say still got some way to go.
That
depends on the regulator.
Depends on the regulator.
Yeah, definitely.
If we looked about
big companies as well.
the UAE globally, I would say that's
that brings in what I was about to share. It's the stick, Phil, nothing else. The penal action has to be disproportionate. If I am making $100,000 and because of some wrong action, which is not justifiable, the penal action should be a couple of $1 million. That will stop me. As an industry across every country, across every regulatory environment, we have tried self-regulation for years and years. We are fooling ourselves. No, it won't happen. The stick comes and everybody will fall in line.
And that nicely leads on to recourse, which I did promise we'd cover. So let's say you become a client in one of these fine gentlemen's firms, and there's an issue with over-promising, not that it would happen with any of these firms, but let's say there was a mismatch in expectations. Then what is the recourse? So why didn't I start with a DFSA regulated firm and you, Damien? Although yours is execution only, so maybe it doesn't really apply. But let's
Yeah.
start off with you.
We're slightly different. But that said, we're headquartered in Denmark, so we've got the Danish Ombudsman. In every jurisdiction we work in, you've got a complaint channel with a regulator you can go to. The other thing you can do with online trading firms in particular is be quite vociferous on social media. And if you're running an online trading firm, that's super important to us in terms of things like net promoter score and customer satisfaction, because we all drive our businesses via that. So I think there's multiple channels. There's a clear channel with the regulator in each of our jurisdictions, but there's also what I would say the soft pressure that you can place via social media.
Yeah, good point. What about ESCA and your firm?
Well, ESCA just have a standard operating procedure. Like we receive a complaint, we have to escalate it. We have internal compliance. Compliance receive that. There's reports to be completed. That goes up the line to ESCA and their complaints division. They investigate, fine-tooth comb the work that's been done. We've got to make sure that all the boxes have been ticked and T's have been crossed, and make sure that everything was in place. And then they'll come down on us if we don't comply.
Got it.
So
it's
pretty
strict.
standard.
Okay, and what about a DFSA firm like you gentlemen?
Yeah, I mean, from our perspective, we, as an extra layer, we have a thing called the St. James's Place Guarantee. And basically that is some security to say that if the advice that is not right for you, even though it's checked over the long term, we will put you back into the place before you invested if it's proved to be not the correct path that you chose. We've always got the standard complaints procedure in exactly the same way. Being regulated through the FCA, we've brought kind of their standards through into the work that we do now in the DFSA and certainly in the Middle East.
You know, I will not win any popularity contest for saying this, but more often than not, when a client feels that he has not being sold correctly, they decide to reach out to the firm who sold them in the first place. More often than not, the relationship manager who sold them in the first place, guess what? He's not going to take care of you. Go to the regulator as quickly as you can. All of us here, if there's one entity we are scared of, it's the regulator. Go to the regulator, you will see how fast we act. A lot of times clients spend time, months and months, trying to get something from the entity itself, but the regulator is actually sitting there waiting for you to go and show them what's gone wrong completely.
Got it. Thanks. Any more questions? Yeah, the gentleman there.
Kamal from Nexus Insurance. My question is to three of you because of the advisory space. Performance-based fees. Is that something fair, do you think? Is that something you encourage or do you practice it at your firms?
It's not something we practice. No. No, we have basically an onboarding fee, and then we have a monitoring fee, which is disclosed at the outset. Very clear, very transparent, and affordable, and agreed with the client. So that's a long-term fee that's in place.
Yeah, we don't have that. We have an initial advice fee at the start and ongoing fees, which again, like we said, are declared on the suitability letter that all clients will sign.
Performance-based fees is getting more and more common in the private banking industry because you're talking about a larger share of wealth, right? Unlike their firms, we don't onboard a client less than $3 million. Our average client holds about $25, $30 with us. And they are becoming aware that we can't make a fee on that, even if it's like 25, 50 bips, and then they lose out on everything. So it's coming into place, but we humans are very creative. So I'm seeing a lot of creative solutions around that, which is I still make my first, 200 bips. Then if it goes above 12%, then we share stuff like that. So I think, it all boils down to transparency finally, Kamal. If you want to do a performance-based fee, make it transparent. And that's where you'll get it. But we, on the client side, we also see certain behavioral patterns. It's well known in the industry, when a client makes money, he believes who was responsible for making money. Any guesses?
He himself. First.
He himself. And when a client loses money, who's responsible for that? So clients also, when if he's made 18, 20%, and then there are times when clients have made, without a guarantee, by the way, right? Clients do make money, right? At that point of time, they are hesitant to share when they sign up. They do, but at that point of time, they don't like it. So I think it's still out there. It's difficult to say if it will really take off, but it's going in that direction.
Got it. Cool. Any more questions? Even from the front row here, very quiet.
Come on, Tim. Give us a
Come
couple of
on.
questions. Goodness me.
Gordon, any questions? Any questions? Okay, well, everyone's now going to stay behind. So let's use this opportunity to do a bit of networking. So thank you very much for your questions. And if you can show your appreciation to the panelists, please. Thank
To
you
the
very much.
victims.
And safe travels back. Thank you very much. Are they going to do
I
some
do want to
pictures?
do a photograph.